So with all the current events going on and what's going on at the Fed, I'm changing my thoughts a little bit. So I figured I would post a new video, the three R's: rates, real estate, and recession. So I want to start off the video by talking about rates. Where do I think rates are going to be in the next, say, 12 months? Real estate, I'm going to explain where my thoughts are for the next, or for at least 2022 through 2023. And then my thoughts on if, when, and how we will enter a recession. So that's what we're going to talk about today. And there's going to be no graphics or anything. I'm just going to give you my feedback. I've been doing this for 33 years. I've been in the mortgage business that whole time, never got out. So I had my feet in this market for the last 33 years, and I've saw all kind of stuff. This one's kind of an anomaly because we've never seen the whole world basically shut down and the government's pumping out monies and the rates at the lowest levels in history and everything else. We know all this stuff. So now it's time to face the reality behind things. So the first thing that I want to go over is rates. Where do I think rates are going to go? Because that's the number one question that people ask me. My thought is about 6 to 6.5%. Now I'll explain, I like to do on this channel, I like to explain the whys. And I'm going to explain that a little bit further on down the road on this one. The next is real estate. Where do I see real estate values going? I'm seeing 2022 up about 5 to 8% at least. 2023, I'm starting to see flatlined. And that's where my changes are starting to take place in that area there, mainly because of the third part of this equation, the recession piece of things. So let's dive into this whole scenario and figure out where we got, or not where we are, how we got here. As you all know, what took place was the whole world just shut down. Right? We know that. Then the government came in and they helped families and everything as much as they could do. Then the Federal Reserve stepped in and drove down interest rates to basically zero. Okay. So at that point, we're trying to feed, or they're trying to feed the whole economy to keep it stable, to keep it at least going so we don't go into a depression, because it would have been easily to drop into a depression. Just think, if you didn't get any stimulus money, what would you have done? If you couldn't have put off your housing payment or your student loan payments, what would you have done? So a lot of those things compiled over time. So now let's go back and let's talk each one of these. So the rates, why am I thinking 6.5%? That in a healthy economy, it should be about 6.5%, 7%. Say now, most of you have never seen that kind of rate ever in your whole history. But in a normal market, we usually see about 6 or 7% interest rates. Okay, we're not in a normal market, but as you can tell by what the Fed's coming out saying on a daily basis, right behind me, they're going to do everything and anything that they can to curtail inflation. Okay, so how are they going to do that? Well, they're going to drive up the one rate that they control, which is the federal funds rate. But then everything is trickled from there. It trickles all through the system. Plus, the Federal Reserve was a big buyer of mortgage-backed securities, thus artificially driving down interest rates. Okay, so now all that is gone. So now we're back to trying to get back to normal, right? So what we're going to see is a lot of pain in the system right now. And it's going to be a shock for probably about a good year. Again, I've lived through several of these and I see it. I'm even prepping my teams to say, hey guys, you got to work 3 times as hard to make half the paychecks right now. But over time, it'll subside and we'll get back to somewhat normal, quasi whatever normal is. So let's break it down. Rates, 6.5%. In a healthy economy, that's probably where we should be. And we could get there within the next 6 to 12 months. Okay, that's that piece of the puzzle. Real estate. What we're going to see in real estate right now, we have a lot of people just tied in. They're in the process of building. They're in the process of buying. They're kind of stuck. And rents have skyrocketed so high that in many areas, not all, but some areas, it's still cheaper to buy. I talked to a realtor, Sir Ashley in the Carolinas, and he's like, dude, there's still areas down here that are more affordable to buy than rent. I'm not saying that's all over the place. I try to reach out to realtors all over the country to get a feel for what they're seeing. Many are saying, yes, it's a hot market. So that's what we're seeing here. So we're seeing right now, there's still supply chain issues, labor issues, but a lot of people are still under contract. So until all that subsides, you're going to see that values continue to go up. All of a sudden, though, it's going to go, and the supply chain's going to loosen up. We're going to have people basically forced back to work. because of the recession that I'm going to talk about here next. You're going to see all that. And then all the building that the builders are doing right now is going to come to a head at some point. So, am I expecting home prices to drop? No. I'm basically seeing, or my expectations are for them to completely flatline, probably 23, 2024, because there'd be a glut of supply. Plus, even I'll even admit it on my end. I was contemplating just selling my house because it's the most I could ever get out of it. And then I'll rent a couple years and determine if I want to live here in Illinois permanently. Do I want to move to Florida, where I want to go, because I'm getting on the latter part of my career. So that's, my personal thoughts behind that. So you might even have people starting to cash out. Now, my interest rate on my loan, my personal loan, is a 30-year fixed at 2.625. So will I ever see that in my lifetime? Probably not. But I'm still, what my discussions are that I try to do a lot of times is just housing. I do care about the rates, but I'm more about the money. How much does it cost me to rent versus buy? And, I break down that analysis. But, as a homeowner, and I've been in my house for 20 years, I don't owe much on it. It's at the peak of its value. Do I sell, cash out, rent for a little bit, put a ton of money in the bank, and weigh this thing out? That's starting to weigh on my mind. So that's that part of it. So that's why I'm saying where rates are going to go, I think the 6.5. The real estate, I see this year still being okay, but in 2023, maybe even in 2024, it's basically just flat. And could we have a little drop in prices? Maybe. It depends on how high you bought. But I don't really see the market crashing because the demand's still huge. But can that demand change because of affordability? And that's why on the channel every day, I monitor where rates are going. But it's not only rates. Because if wages kept up with things, the rate wouldn't really be an issue. If you were getting, 5% increases or 10 or 15% increases in your wages each year, you're like, okay, it doesn't really matter. But if you did that too, then we'd have inflation skyrocketing because of wage inflation. So it's an intertwining scenario with all this. So now the biggest thing is the Fed's reactions going to push us into a recession? So let's throw away the technicals, but let's just talk about the technicals real quick. The inverted yield curve. Everybody's like, that is dead on. It's always accurate and so forth. Well, unfortunately or fortunately, the inverted yield curve is pretty much straightened out right now. So that's not into play. But the biggest fear I have is the Fed coming in and basically shocking all in the system. They were there for years saying 0, 0, 0, we're not going to do anything. Now it's all, bar everything because we're going to do anything and everything it takes to keep inflation under control. However, they really haven't said that up until just recently, and their actions haven't really portrayed what they're saying. They went and they increased the federal funds rate last week by 50 basis points. They could have did 75 and completely shocked the whole system. They could have did 100 basis points, probably would have just crashed the markets, but then we can at least build from there because we know that they're really working on this stuff. But, only time's going to tell there. But one caveat we do have in our favor this year is we have some elections coming due in November. Now, election years do play a role in this because a lot of the Congress people and the government people dangle a lot of things out there. The Federal Reserve isn't going to want, the Federal Reserve chairman just got appointed for another, I think it was 2 years or so. So he's not really going to want to shake the boat there. So believe it or not, there is politics involved as well. So there's uncertain times, but where I see things, I'm going to conclude this in the bubble, the 3 R's. We're going to talk rates, real estate, and recession. I'm seeing rates at about 6.5. That's where we should peak. If you're there now, you're probably not going to see much of an increase in rates that I foresee, because if you do that, then the Fed and everybody else is going to go back in and say, wait a second, and they're going to kick the can. It might help, for a year or so again, but then it's going to be a complete fiasco at the end of this. The next thing is real estate. We still, and I know people hate to hear this, we still have a supply issue, but it's getting worked on tremendously. There's 1 or 2 areas there that I still think is going to be keep a lid on the number of properties or the supply is people like me, but not have the opportunity to be able to move or sell on their house. So if I have a 2.625 rate on my mortgage, probably shouldn't ever sell the darn thing. So maybe I'll give it to my kids or something. So that might be the thing where some people just don't put off selling because of that. We have other people that were in a forbearance, got a modification. I spoke with several today, and their modifications are crazy good. Most of them were able to modify their loans in the twos on a 40-year term. Are those people going to sell? Not anytime soon. Then that equates into the foreclosure piece of the puzzle. The foreclosure piece of the puzzle usually takes up about a 5 or 8% piece of the real estate bubble, or the real estate supply. Okay, well, you have foreclosures really, really, really down because most people were in a forbearance for about 2 years. Then they came out and the banks are working on them with the modifications. So you're going to have lack of supply because of not a lot of people going into foreclosure at this point too. I know there's a lot of clickbait out there for a whole bunch of other things. This is my perspective on it. And I usually provide you the context, but I'm trying to make this video just as short and as upfront as I can with you in regards to where I see the 3 R's being and where they're going to go and the why. So hopefully you found some value in this video. If you did, all I ask you to do is give us a thumbs up, subscribe down below, hit the bell every time we post a video, you get an alert. God bless, guys. Thank you so much for watching, and I hope you do find some value in my channel. Thanks so much. Take care. Bye-bye.